Let's talk about hedge funds. And in the picture, you can see a bunch of hedges. There's hedges on one side of the backyard, the other side of the backyard. I wish it was my backyard. It's not. There's also hedges behind me. And then right behind you, there's hedges as well. And hedges is a metaphor of representing protection. Okay. Your backyard is hedged or protect, right, by these bushes. And so hedge funds is all about capital preservation, capital protection. Protect your capital first and then focus on making money second. So in a down market, if you work at a hedge fund or you invest in a hedge fund, you might be able to make money, but you want to preserve capital first. And hedge funds are very risky, right? There's big risk, but then there's enormous returns as well, right? So it all depends on what you're most interested in. So let's talk about the who, what, when, why, where, and how of hedge funds. So a hedge fund buys stocks and shorts stocks. Okay, so buying a stock is called a long, right? You're long the stock. And the opposite of that is called a short position. You're shorting a stock, you're basically selling it and then buying it back lower, right? And I'll give you examples of how that works later. And you also have pair trades, which means that you can buy one stock in a sector you think is going to go up and bet against or short another stock in a sector you think is going to go down. And the way you make money is if you make money in the long goes up and the short goes down. But you can also preserve capital. So let's say that you wanted to invest in Google and you think Google's taking share from Microsoft. Well, what you can do is you can go long Google and you can go short or bet against Microsoft, right? And that way, even if you don't make money on one side of the trade, you're protected, right? So if you think about it, if something awful happens and the market goes down a lot, these two stocks will go down. You'll lose money on the long position, which is Google, but you'll make money on the down position, which is Microsoft. Okay, so they think in terms of risk management. Analysts don't have to think too much about risk management yet, but they do if they want to get promoted to portfolio manager. And I'll talk a lot about that later in this course. Okay, so the fees for a hedge fund are 2 and 20, right? You'll hear that a lot in the hedge fund and the private equity industry, and even venture capital. People will say 2 and 20. What does that mean? Well, you pay an annual 2% management fee to have your money managed by a hedge fund, okay? And then they keep 20% of the profit. So if you make $100 investing in a hedge fund, you get 80, they get 20. So your interests are definitely aligned. And the best hedge funds will charge much higher than this. Okay, so hedge funds are only for accredited investors, meaning very, very high net worth investors or big institutions. And the reason the government set it up this way is because it's a risky proposition investing in a hedge fund. And they don't want, individual investors that don't have that much capital to lose it all. Okay, so it's only for accredited investors. And large institutions are clients too, like pension funds sometimes, or endowments, that sort of thing. And a lot of these aforementioned investment firms love to invest offshore, okay, so that they can save money on taxes, right? We're not going there though. We're not tax accountants. And ultra high net worths obviously invest in hedge funds quite a bit. So let's talk about some of the largest hedge funds. Bridgewater is the biggest one in the world by far, right? And they're based in Connecticut. And they have a very secretive culture, but they also record every single meeting that's taking place at the company, except in the bathrooms. I'm not joking. There's a couple companies on here that are what I like to refer to as Tiger Cubs, okay? And Tiger was a great hedge fund founded by Julian Robertson back in the 1990s. And he was brilliant because he wasn't short-term focused. He was long-term focused and focused on fundamentals and didn't worry as much about volatility. And a lot of people left that firm, Tiger, and started their own firms like Lone Pine or Viking or Maverick. And those are what are called Tiger Cubs. And if you're interested in working in this sector, I would recommend going to a Tiger Cub because I love how long-term they focus. Now, in terms of the history of the industry, apparently the first hedge fund came out in 1949. But Warren Buffett would disagree. He thought that the first hedge fund investor was actually Benjamin Graham, who was his professor at Columbia University. And if you get a chance, read The Intelligent Investor, especially if you like to think longer term, right? It's an amazing resource. All right, so why do people invest in hedge funds? Number one, capital preservation, right? They like to preserve capital first and then make money second. Next up is absolute returns, right? They want to make money in down markets and up markets. Also, hedge funds do a good job of managing risk, right? If they don't use leverage. And we'll cover leverage later. How do you short a stock? In this example, we have Horatio, our hedge fund analyst, pitching GoPro as a short to his boss, Pam. And Pam always tells him to please make sure to give his thoughts on valuation fundamentals, technicals, and a catalyst, meaning why should they put the position on today? And we'll cover all these topics later in more detail. In terms of the valuation, he's saying the stock's expensive. Pam then says, well, maybe it's expensive for a reason. Maybe growth is high. And he says, no, earnings will probably go down in the next 5 years. Next up, Pam says, what are your thoughts on the fundamentals? He then says, Pam, I don't see how the company can be relevant in the long run because there's competing products out there. And so she says, great, what do you think of the technicals? And then he says, look at this chart. The stock is breaking down. You could see on the right side there, the stock is breaking through the red line. We'll cover that in more detail later. Why now? What is the reason for shorting today? And he says, and this is hypothetical only, that Apple and Google have competing products coming out soon. And Pam says, great. She blesses it, and she tells him to tell Tarek, the trader, to see if it looks like a good short from a technical perspective. And Tarek looks into it and says, yeah, it's cheap to borrow, and the chart is breaking down. And I'll explain what all this means later on in the course. And so they put on this position as a GTC, or good till completed position, and that is the anatomy of a short. How is a hedge fund set up? Well, I'm going to give you a hypothetical example. This hedge fund is based in New York City, and there's one owner. It's the CEO and the founder. And reporting to the CEO and founder is the CIO, the CFO, and the COO. And a number of different portfolio managers report directly into the CIO, a technology portfolio manager, a telecom portfolio manager, consumer portfolio manager, etc. And let's take a look at the technology portfolio manager. Recall it's Pam from our previous examples. And Pam, because she covers technology, is more likely than not going to be based on the West Coast in the San Francisco Bay Area. And she has a number of different analysts that report directly to her, and she also has a trader on the right side there, Tarek, reporting to her. And each one of her analysts are specialists or experts in different sectors, from the semiconductor sector to the software sector to hardware to internet, etc. And let's look at a couple of examples here. So the first one we're going to look at is the semiconductor analyst, and she is an expert in Intel, AMD, NVIDIA, as well as Qualcomm. And next up, we have our analyst Horatio, who covers the internet sector, and he is an expert in Google, Facebook, Amazon, eBay, and many other internet companies. So here's an example of my hedge fund. I had offshore and onshore investors. And I chose to set up the offshore hedge fund in the British Virgin Islands, or BVI, because it's much cheaper to set up in that region versus Cayman Islands. People will say Cayman is more prestigious, but I'm all about lower costs. Now, in terms of my investors, there were high net worths and institutions as well. I owned most of the firm, but I had a minor shareholder, right? And it was just a high net worth family here in the Bay Area, and they were fantastic. And in terms of the service providers, I worked with a number of great companies. There was the Security Law Group, which did all the legal stuff for me. And then I had my prime broker was BTIG, and they were awesome. And then Goldman Sachs was my custodian. And so here's where a lot of the funds are located. For some reason, a lot of them are in Connecticut. I can't understand why. A bunch are in New York as well. So the East Coast definitely dominates the hedge fund industry. And you've got a number of ones overseas as well.